Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand, evidence-based holistic insights to help you master the game of building wealth. And in my regular Wednesday episodes, I talk about the theories, methodologies and principles associated with investing. In these case study episodes, I want to share with you how all that works out in real life by talking about one of my clients that I might have been working with over a number of years. And today's episode is about some clients that I guess started the investment journey a little bit later in life, and I'll describe what we've done over the last 9 years or so in order to get them into a position where they're now in a really strong financial position. So we began working with them in 2015, so about 9 years ago from a financial advisory perspective, but actually 6 years prior to that, in 2009, they purchased a investment grade apartment, a one-bedroom investment grade apartment in a suburb in Melbourne called South Yarra, which is a blue chip suburb, probably familiar with it. So that was in 2019. We just assisted with the finance of that investment property that was purchased with some advice from a buyer's agent. It's a lovely location in South Yarra, just opposite Fawkner Park. It's beautiful, except for the fact that the property really hasn't done very much in terms of capital growth since 2009. They almost timed the market perfectly in that they bought, really at the peak. And since 2009, the apartment market in Melbourne has just moved sideways at best in line with inflation. Now, whether they had the capacity in 2009 and the appetite in 2009 to invest in something more valuable, something higher quality, I'm not sure. I can't speak to that. I can't recall their circumstances back in 2009. I'm not even sure we were involved in that decision making. I'm pretty sure we weren't, but it is what it is, right? It's still a great property. It just hasn't performed. Anyway, so we started working with them in 2015 where we mapped out a long-term plan, which included buying another investment property, a house this time. Obviously, what we wanted to do is we thought, yes, South Yarra was a good investment grade property, but let's mitigate the risk that it actually doesn't work, that for whatever reason, it's not going to drive the capital growth. And so we bought a house with the advice from a buyer's agent. We bought a house in Richmond for 1.3 in 2016. And then over the last number of years since then, so it's the last 8 years, we've been really focusing on, cash flow management, looking after the investment property cash flow, negative cash flow. One of the spouses' super was at Hester. It was underperforming. We moved that onto a wrap platform. And the other spouse had a defined benefit superannuation with UniSuper. They both work in the education sector. And because it's defined benefit, there's really no incentive. There's a massive disincentive to move it because you don't have the market risk with defined benefit. So we kind of like the fact that, one's at UniSuper. That's not an industry fund per se, more an employer fund, but, industry fund type. And then one on sort of wrap platform. And we've really been focusing on maximising super contributions, even making some additional contributions and making sure that's working really well as a little bit of cash flow management in terms of debt reduction. And thankfully in 2015, their combined super was about 770,000. Now today it's $2.3 million at their combined super. So, it really does show that performance is so critical. If you get to that sort of $500,000 level, it's the compounding that really then takes off in terms of supercharging your super. So if you're at that level, the next 10 years makes a big difference. Like if you do really well, if your super's well invested and low fees, etc., it'll do well. If it's not going to do so well. Now, 8 years later, the investment property in Richmond, we bought it for 1.3. It's probably worth 1.4 to 1.5, somewhere in that range. So it hasn't done that well from a capital growth perspective, although, I've spoken ad nauseum about Melbourne over the last 10 years underperforming, particularly in the last 7 years has greatly underperformed. So, timing is a little off there, although I recorded an episode a few weeks ago where I concluded that I think Melbourne's going to have the largest dollar value gain over the next 10 years. So they're well positioned for their property assets to pick up a lot of those gains. Meanwhile, their super has done really well. So at least it gives them the grounding, the financial grounding to contemplate retirement over the next couple of years. And then, over the next 10 years, their asset base will continue to grow substantially, even though they might be drawing a pension from super, because the property assets will start to come into play. As I do in all these case study episodes, I like to reflect on what are the key sort of learnings or insights that we can get from looking at this client case study. Well, there's a few. There's 5, in fact. First, they didn't start investing until mid-40s when they bought that low-end one-bedroom apartment apartment. Low end in terms of quality, of course, just because of the price point. But they didn't really get serious until they were almost 50. So they started a little bit later than maybe what most people did. But it shows that even if you don't start until late 40s, early 50s, as long as you've still got enough time horizon, say 10 years, you can still turn the ship around and, build some substantial wealth. They're lucky enough that their super balance is pretty healthy for their ages at that point. The second lesson that really stands out to me is that price point matters with respect to investment properties. Back in 2009, if they had have bought, either a 2-bedroom apartment, slightly higher quality, maybe even a house, if they could have stretched as far as that and really pushed the envelope, they would be in a much better position today than what they are with that 1-bedroom apartment. Quality matters, and the price point really dictates the quality of the underlying asset. And so we've just got to realise, it's been a bit of a strange situation over the last 10 years in Melbourne with apartments, so I get that it won't necessarily repeat again in our lifetime, but quality really does matter. The third observation is I really like it when clients have, some super with an industry fund, if it's a really good industry fund with, good long-term returns, and then one on say a wrap platform using the methodologies that we talk about. Now, we've got lots of clients where all their super is on the wrap platform. That's fine too, but I like the fact that, if we sort of spread our risk a little bit. Now, the wrap platform allows us to implement a strategy that's very rules-based, low-cost indexing, etc., etc., and it performs incredibly well. But, being solely reliant, let me put it a different way, because being solely reliant on the industry fund sector is a little bit of a cause for concern. In their situation, we didn't have any choice because one of the spouses had a defined benefit super. So, they were kind of stuck at uni super, which is fine, but the other spouse's super has done really well. Number 4, they are in a really strong financial situation. They've got a really healthy super balance. So, super will easily fund the first phase of a retirement, potentially the whole retirement. But essentially, because it will fund that first phase of retirement very comfortably, they can easily hang on to these property assets for another 20 years. And that'll give them plenty of time to generate lots of capital growth. And property needs time. You need to level out those growth and flat cycles. And the longer that you hold property, the higher the probability that you'll be happy with the return. So 10 years, you've got to be lucky with your timing. If you can hang on 20 years, chances are you'll do pretty well. If you can hang on 30 years, very high probability of doing exceptionally well, particularly from a dollar value perspective. So they should be able to hang on for another 20 years, which will give them a full 30 years in the market, and it will do its thing. And the fifth observation is it takes a long time for your super, as I just said previously, to get to sort of 5 to 700,000. It can take almost your entire working life to get to that level. But once you're at that level, that's when compounding capital growth really kicks off. And so you should be able to go from 500 to a million within about 6 or 7 years. And then from 1 million to 2 million in about 5 or 6 years. In a normalized market, that's typically on average what we would see. Now, you'd only achieve that if you're with a good fund that's achieving good returns for low fees. And so how your super is invested in that sort of last 10 years of your working life, absolutely critical in terms of what your balance will do. Now, it's critical beyond that as well when you're in retirement and you're drawing a pension, because if you're taking money out of super, hopefully your balance continues to appreciate by a greater margin than what you're withdrawing. But again, that comes down to returns and fees. So I thought it was a good case study to share just because they start a little bit later in life. And sometimes I speak to people and they're a little bit concerned that they're a bit behind the 8 ball, but hopefully it gives some people some confidence that there are answers if they're willing to seek them out. Okay, until tomorrow, bye for now.